contrasting debt capital markets in the current climate with the syndicated loan market. I think you'll find after our discussion that it's more of a cooperation between the markets than a contrast or a competition. But welcome everybody. I'd like to introduce Sam Bordereau, who is the head of LatAm loan syndications for Scotiabank. Sam covers public and private sector issuers or borrowers and originates, structures, and executes and distributes syndicated loans in the region. In the past 5 years, Scotia has syndicated more than $20 billion of loans in the region. And to my right, I also have Isabella Serassi, who is responsible for the debt capital markets and structured finance for Brazilian company Vibria Cellulose, which is the world's largest producer of hardwood pulp. As the head of debt capital markets and the structured finance team, Isabella has worked on many transactions, including a $700 million green bond, $400 million Finnish export credit agency facility, and more than $1 billion of export prepayment bank facilities. Welcome for the panel to give us some perspective from the borrower or issuer perspective. And to my left, I have Ignacio Lorenzo, who is the head of structured finance at Banco Santander in Brazil. His team leads acquisition and finance and asset-based finance in Brazil and across client segments, including global clients to middle market. And in the last 16 years, Ignacio has covered many aspects of loan credits in the region, including risk management, portfolio management, and CDS and structured finance. And then we all know Neil from his very helpful presentation earlier today. We're not going to feel, I think earlier there were circulated some bullet points. We're not going to be tied to those, but really are hoping to just have a very helpful conversation, which is fluid and touches on points that are relevant to the market. And I'd like to open it up to really just get the participants' perspectives on the current market. Maybe start with Sam.
Okay, sure. So, I mean, the loan, both instruments, loans and bonds, are or can be tailored, to fit the needs of the companies. And at the end of the day, you realize that the universe of companies that have access to the bond market is much smaller than the one that have access to the loan market. And one of the main reasons is, a lot of companies lack the size and the debt quantum needed to access the fixed income market. So you realize that the loan is really more flexible and can be tailored to fit the needs of companies. One of the main aspects is obviously the repayment profile of bank loans versus the bonds. Another main difference is also, loans can be adjusted or modified during their life and are more flexible than the bonds can be. So, I mean, both markets are currently very liquid. I think Neil touched base a little bit on interest rate. They are still at historical lows. So there's a lot of liquidity in the market. Companies are taking advantage of this low interest to secure, some bond financings. But I would say the majority of the companies do not have access to those markets. So it's not exclusively reserved to investment-grade companies or large, international corporates. But unlike in the U.S., you have a lack of institutional market in most of the countries in Latin America. So many companies in non-investment grade land still relies heavily on banks to finance their needs.
Ignacio, do you have perspectives on the Brazilian market?
And LatAm market as well.
Market,
yeah,
sir.
I think I fully agree with Sam. I think both markets are open. For the first time in a long time, both markets are open. You see both investors and banks eager to grow positions in the region. But when you take a step back and look at the historical perspective, how the two markets have evolved over the last, let's say, 7 years is we find some curious conclusions. Like in 2010, when I started my observations, we saw that the loan market, the syndicated loan market in LatAm was as big as the bond market in the region. It was roughly a $30 billion market for each one. And the loan market was much more granular. There were more issues than in the bond market. We used to do 60 transactions a year compared to 30. Now, when you look at last year, the loan market stayed at the same level, so we still are doing $30 billion a year, whereas the DCM market has grown to 120. So it's 4 times bigger now. So that this is to some conclusions. What has happened to us in the region? Why haven't we been able to develop the loan market at the same pace as the DCM market? And despite having more flexible structures, despite having more granularity on the potential names, we couldn't catch up with the loan market. And I think we have to ask ourselves why have we been able to bring new names to the loan market? I have some ideas, and of course, this is open for debate why this is the case. I think the development of the local market explains a bit of that behavior. Local markets have taken a lot of the space of the offshore market. I also think that the unstable political scenario in the region in the last couple of years has affected a lot the loan market. And honestly, that's my contribution to this point. But again, something that we need to think about because we have flexibility. We don't require ratings on our issues. We are relationship banks to the clients, so we tend to be more friendly than institutional investors, and we still haven't been able to develop that market.
And I think one piece of information that is missing from this data is the bilateral loans. I think, many of the loans in the region are driven by relationship, and the information we have from the market are based on syndicated loans and club deals. But I think the bulk of the lending is done on a bilateral basis. Especially you see that for large corporates and smaller corporates also. So I think the flexibility obviously you find in the loan product is not necessarily reflected in the data that we can find, because I don't think there's any information on bilateral loans. So even though you see our market, the loan syndication market has dropped in the past 4 years in terms of volume, but not because there are less loans. I think it's because the type of loans are being done on more on a bilateral basis than.
And I think there's something also to saying, you can look at the aggregate statistics and see that the bond market may have been growing at a faster pace than the loan market, which still doesn't necessarily lead you to the conclusion about which product is right for any particular circumstance, right? If a corporate needs an acquisition facility and needs certain funds, the loan market may be a better place to start, and I guess depending on what the aggregate purchase price is from the borrower's perspective.
Yeah, in terms of demand, I feel that banks are much more much more focused on fundamentals than bond markets, and therefore less volatile. You have more chance to negotiate. They are more flexible. So I would assume, at least for Fibra, they are always there for you, and you be able to get a loan from them. Of course, price and volumes that will change depending on the scenario. And on the other hand, the bond market is much more volatile. You need to follow the market and everything that is going on globally very closely, choose the best moment to have a window. It is currently open, but it couldn't be this way, so it is more complicated to access the bond market. You have to check on everything, and when you decide to go, you have to make a very good marketing strategy, to define a very good initial price, to make sure that you receive a considerable demand from investors that will enable you to tighten your yields and issue a good volume, the volume that you are expecting to issue. So I think that's it.
Ignacio, or do you have
No, I was just going to chip in two things on bond markets in particular. I think it's going to be quite interesting. Over the next year, how things play out. Externally, what happens in the US with the Fed? So we know the Fed is now beginning the process of balance sheet normalization. It's winding down the size of its balance sheet. That starts next month. It's given a pretty heavy hint that it's going to start raising interest rates again in December. For what it's worth, we think there'll be another 4 increases in the Fed funds rate next year on a quarterly track. So that's going to push up US yields. So I think hard currency bond yields are going to go in one direction next year, which is up. And then you interplay that with what's happening domestically in Latin America. We've already touched upon it a bit, this busy election period. It feels to me like there might be a kind of very narrow window of opportunity for the bond market in the next 6 months. And the second half of next year, when you've got this interplay of higher US rates with elections, particularly in Mexico and Brazil, which are still very uncertain. I think in the other countries, I think we can be reasonably clear about how things are going to play out. But Brazil and Mexico are the two big uncertainties here. Is this narrow window of opportunity perhaps to issue?
I mean, I think that's a good point, and I know the panel's originally framed around bonds versus loans, but I think obviously there's another element, which is local versus international and currencies. Ignacio, do you have thoughts about that?
Yeah, absolutely. I think we work together with the DCM teams. We always try to find the best solution for the client. As Sam was saying before, the potential issues for the international market, both bonds and loans, is quite limited. So by default, many of those names go down the road of the local market, which in some of the markets like Colombia, Mexico, and Brazil are quite developed. So you still find market for that, both on the loans and the DCM side. And then we decide which way to go. I think there are a couple of products that play in our advantage. For instance, confidential transactions like an acquisition financing do require a loan solution at the beginning. It could be taken out by a bond at a second stage. Then things like backstop facility, revolvers, those are things that we always channel through the loan market. And when you have the two markets, that's where the competition gets a little bit complicated, because the DCM market tends to be probably a better option. They have longer tenors. In the local markets, they tend to have better pricing as well. So it's really a consented decision between the two teams about the way to go. But our pitch to the client, and I want to see Isabella's perspective on that one, should be a single one. We have to bring the mandate to our house and then see who is going to execute it at the end of the day, either DCM loans, local or international.
Yeah, I mean, in Brazil, the local debt capital markets started picking up in 2015, especially with subsidized instruments such as the CRAs, a local debenture. And it is very competitive and attractive in terms of price, because it is exempt of withholding taxes for persons that invest on it. So it is a very good source of funding for Brazilian companies. And Fibria, for example, started issuing these local debentures instead of international ones. Of course, we do both, but we have currently an outstanding amount of 5 billion reais in these local debentures named CRAs. Well, so what I can say is that local debt capital markets are also a good alternative.
Also, I guess, depending on the currency of your revenues,
Yeah,
just
of course,
to make sure that you've got a match there.
Right. No, I was going to say, I'm privileged to work in a bank where we have capabilities in local currency and dollars in most of the countries in Latin America. So it's interesting to see the difference between the two markets. On one side, the local markets are much more focused on investment grade and high quality issuers. The depth of the market is usually not as large as the international market. You mostly have pension funds and insurance company. That's about the extent of the investors in your local market. While in the international markets, like the most recent issuances in the bond market have been oversubscribed by 5 to 9 times. So there's very strong demand. But to add to Neil's point, I think it's interesting with the all the elections of next year, how borrowers are also looking at structuring the acquisition financing. The typical product that we sell for an acquisition financing is a bridge to bond. But so how do you structure your bridge if you think that the market is not going to be open next year? I'm thinking about Mexico and Brazil, are the two main markets where you have elections next year. So we've seen a lot of our clients trying to negotiate different structure. Instead of the typical 12-month bridge, you try to put in place a more permanent type of financing. You're going 3, 4 years, 5 years, still with the intent of issuing in the bond market or refinancing that loan in the bond market as soon as possible. But they want, we see our clients wanting the flexibility of not having, a hard deadline after 12 months. And I think that's something that banks obviously can provide that the market, the capital markets can have.
And I think that's an interesting contrast with the typical U.S. market, right? Where I think bridge terms are a little bit more standard and a little bit more rigid. And I think we've also seen a lot more flexibility on the Latin American side, probably in part due to company and borrower demand under volatile circumstances.
Right, and in that case, the bonds and loans are not necessarily mutually exclusive. They can be complementary in many cases.
How do you structure your teams internally around bonds versus loans and facing clients?
Yeah, so the LatAm teams sit together, although we have different line of reporting, so we are really separate teams. But many times we end up pitching clients together. Like I said, there are some opportunities where the clients need a bond and a loan. So very often, we work very closely with our DCM team to pitch clients together. Again, we have local teams also in each of the countries that we have presence in. The main one being, Peru, Chile, Colombia, Mexico. Smaller team in Brazil, but obviously more focused on larger clients and such as Fibria. But we work very closely together because I think at the end of the day, if the client decides to go with one solution versus the other or both, I think we need to be in tune with the needs of our clients.
Ignacio?
Yeah, we have a similar model in Santander. We have strong franchises in Brazil, Mexico, Chile, Argentina, and we have teams on the ground with the structure and execution capabilities supported by desks in New York for both bonds and loans. The DCM people sit on the private side, so they sit next to us, and that makes things easier in terms of prospecting clients and seeing the interaction that I mentioned on the previous question, how we go about the transaction. So the setup that we have, I think, is a good one, and we always get the benefits of the deal done, either the way of a loan or a bond.
I guess, aside from Scotia and Santander, how have you been approached by banks?
Well,
Has it worked?
from the borrower's perspective, when banks comes to us with proposals, when we are defining our funding strategy, we usually check for a few things. That is mainly maturities, prices, costs, volumes, and also the contractual terms of each instruments. So I think we start with checking how the new money payment schedule would fit to our current debt amortization schedule. And with bank loans, you have more flexibility to do this or that, but they are usually short term than bonds that could go up to 10, 30 or even more, 10, 30 years or even more. So we need to check if we don't have much pressure on the short term of our amortization schedule. If we do, maybe it's a good idea to extend maturities and issue a bond. And that is what we need to do with maturities. And there's the other driver, very important one, is the cost. We'll obviously compare the instruments and check for their attractiveness, weighting with maturities, and what fits the best for us. And there's another thing that we need to have in mind, that is the volume that we intend or that we need to issue. And maybe we just need a combination of both bonds and bank loans. Usually bonds, you can have higher amounts, I mean billions of dollars. It feels like banks, it's lesser amounts, but you can decide to have either one or other or combine both. So, and finally, we always check for the customary covenants package and see, weigh the pros and cons of each instrument and see how it affects the company's flexibility to take decisions. I wouldn't say that this is the main thing that we see, but we also need to check on these things.
Very helpful.
Yeah, I would say, I mean, typically the covenant package in bonds are much more issuer friendly than what you can find, in the bank financings.
Yeah.
I think it's focusing in on an acquisition finance situation where you might have, bridge to bond. Sam, I guess, maybe you can give us some ideas about how
so
you
we
structure.
came across a few of those situations. I mean, thankfully, the M&A activity has been picking up, I would say, the past year. Last year, I can take that as an example. When I mentioned that the typical 12-month bridge is not that, it's atypical, I would say, in Latin America, because issuers always want more flexibility. And that has to do with the volatility in the fixed income markets, because you have a window of opportunity to issue, but for new issuers, you need to go through a rating process that takes typically 6 to 8 weeks. So you need some time. Very often also with acquisition financing, you need regulatory approval. That can take a few months. So you never know where the market is going to be at the time you decide to issue. And that's why I think many issuers or companies want more flexibility in the terms they can get for the acquisition financing that the banks provide. We done, for example, an acquisition financing for Phoenix Power last year. It's a combined cycle that was acquired by Colbún. The combined cycle is in Peru, and we put in place a multi-year facility. So the client had the ability to, don't depend on the few windows of opportunity they can have in the capital market. So they actually issued a bond last month. So within a year actually of the acquisition financing. So they found the opportunity, they saw an opportunity, and they took it. But again, the typical 12-month bridge is more a U.S. concept than the LatAm concept.
In my case, we basically follow two strategies with the bridges to bonds. I think for solid and proven names, we go the way of a bridge to take out, and probably put some conditions to incentivize the takeout, such as price step-ups or go-to-market clauses. And for names where we don't have so much visibility, either because the issue never issue or because we see a scenario of uncertainty over the DCM market, then we do term loans with the optionality of prepayment. That alternative is more costly to the client, but in the end, it gives more comfort to our credit committees, because if something happens with the takeout, at least you stay on the loan and you make sure that you get repaid through the loan. So we decide on, depending on those situations, which way we go. We have several examples. We have cases where we structure the bridge and the takeout accelerates itself, and it happens before we actually disperse the loan. So we have an example in Santander when BAT acquired the remaining portion of their subsidiary in Brazil, Sousa Cruz. It was a 10 billion reais transaction, so a $3 billion transaction, and we give a firm check for a bridge to bond, and the process delayed more than expected, given regulation delays and things like that. So by the time they actually had to pay for the offer, they had already squared out the bond and also an offshore loan, and we didn't have to disperse our transaction. So that's at least how we approach it in Santander.
Isabella from
Yeah,
the borrower's perspective.
as they said, the borrowers, we always want flexibility, and especially when you are going to an M&A, sometimes you issue the money, you put this on cash, but you are still waiting for approvals, government approvals, and see how things will evolve, and you ask banks, I need a repayment provision with no premium, nothing, no charges, or in a bond, I want to include a call provision with very low premium so that I can pay back the money if I don't need it anymore, if something happens to the M&A acquisition. So I think flexibility is the word, as they said, and that is what borrowers will demand from the banks.
Yeah, I think for well-rated issuers and strong issuers like yourself, it's a lot easier to negotiate, those type of terms. It's not necessarily the norm. Others. So at the end of the day, the loan is still a more flexible product than the bond.
Of course.
Do you have any?
I've never issued a bond nor a loan. But so one thing I'm quite interested in is I look at things at a kind of macro perspective. And I showed a chart earlier where you see business confidence picking up, fixed investment should pick up. That all means, that needs to be financed somehow, bonds, loans, however it may be. But I'm quite interested and intrigued in this cycle about the sectoral ways this plays out. Whether, and you guys are much closer to this, but whether you're seeing any trends in sectors and whether they're different from the previous sectors. So there's obviously types of activity, M&A activity, kind of borrowing to invest, everything else. But whether you're seeing any difference in sectoral.
I mean, one thing that we had to discuss this morning was there seems to be a trend around political volatility for companies to refinance before elections.
Yeah.
And so we've seen that activity in Mexico and in Brazil, where there's been just very heightened activity ahead of the elections, so that everybody, even for acquisitions, people want to complete their acquisitions before regime change and refinance their long-term capital solutions before regime change. And so we've seen some volatility there. I don't know whether you've seen any.
Yeah, I mean, we see a lot of activity in the power sector and infrastructure sector, both in Mexico and obviously in Colombia with even though the 4G program, has been delayed and a lot less projects are coming to market, we still expect the infra sector to be very active. You see that in the US. I mean, there's a huge need for new infrastructure. So we have to figure out how to finance it.
Yeah.
But I think it's a sector we see becoming very active in the coming year.
I agree. Power infrastructure, I would say retail too. We see a lot of M&A activity involving retail as targets. So financial sponsors looking to buy retail assets around the region. But to your question, I think it's more of a country risk-driven decision than a sector-driven decision. I think the country risk plays always a stronger role than the sector itself. It has to be a sector with profile to issue offshore. It has to have either revenues or offshore activities. So we made those mistakes in the past of giving dollars to local currency-based companies, and the results are there. We pay the consequences of that. So that's a lesson that we learn, and we try to lend to people who can pay offshore without trying to avoid or mitigating the cross-border risk. But even despite that, the country risk is always the one that says, you are good to go or not. And the sector accommodates itself. Like you were saying, the election cycle next year in Mexico, Colombia, and Brazil, right?
Yeah.
That's going to prompt a lot of activity, refinancing activity, and that's indifferent of the sector. I think anyone who has a maturity in the next 24 months, I would strongly suggest to look at the refinancing ahead of time, because no one knows what's going to happen in those three countries. So again, it's always been like that in this region.
Do you have other?
And no, well, just to add to what Ignacio just said, I think companies are also being more careful managing their currency mismatch. So, the local markets are well, more or less deep, depending on the countries. But I think you see a lot of issuers that were heavily with debt in US dollars, have switched over the past couple of years into local currency debt to avoid, given the fluctuation in the local currency versus the dollar, and that has been very important in the past few years. We've seen a trend of companies, being actually more careful with the type of currency of their debt. And I don't know for Fibria, you're exporting a lot actually, so it makes sense for you to have debt denominated in US dollars, or the majority of your debt denominated in dollars. But you said earlier that you're still focusing on the local market.
Yeah, you're correct. Most of our debt is in US dollars, but we are also looking for opportunities, and this local debenture was a very good opportunity, subsidized by the government, so we went there, we issued, and it is a money that will leave sitting on our cash, strengthening our cash position, and it actually is a free insurance to have, because we issue at a smaller price than we invest our money in Brazil.
Okay.
So that's why we are issuing so much money in local debentures. That's the main reason. And with all the volatility that we have in Brazil, it's good to have a good cash position, making sure that you'll be prepared for anything, any scenario that would come. But we are very worried about this currency mismatch, and most of our debt is in US dollars as we are exporters.
I think we have a few minutes if anybody has any questions for the panelists. I think there's this one.
Thank you. So I hear a lot of the panel talking about flexibility for the financings. But what about certainty, given the political instability coming up in Mexico and Brazil? What about the usage of committed facilities throughout these points? How do the banks see the use of these committed facilities as also clients? How do they think about the usage of committed facilities?
Sorry, the use of committed?
Yeah, fully committed facilities. Usually bilaterals, you can pull them at some point, but committed facilities.
Right. Well, I would say for the, most of the syndicated loans that we provide are committed financing. So I'm not sure how to answer your question on the bilateral basis. I think you obviously you have both type of facilities, but I know the trend is, issuers are trying to secure, committed lines of financing to better weather, I guess, the political uncertainties in the coming months.
I mean, from the borrower's perspective, we go for syndicated loans. We always ask for a commitment amount from the coordinators banks, and that is a very huge pro when comparing to bonds, because if you decide to go to a bond, you don't have this commitment, and you are up to the market to see if you get the money at that moment or no. So this is a very pro for the syndicated loans market.
I think there was a question over there.
Just a quick question on the state of demand on the part of financial institutions in Brazil for loan syndicated facilities.
Was that a question of the demand?
Question, yes, please.
Sorry, I didn't hear the question.
We couldn't hear the question.
Because we heard a lot of interesting discussions about the perspective of the corporate board, such as FIBRA, but I'm a corporate board as well, so that's the perspective that I'm more familiar with. So I'm very interested with what is it that the financial institutions, especially in Brazil, are or are not demanding from the international banks in terms of syndicated financing at this point in time. Whether there's any demand at all, for example.
I think the financial, if I understand the question correctly, whenever there is availability or liquidity from financial institutions, that's a better option, and borrowers prefer that option because it's a lot cheaper than the syndicated loan. The cost of financing of banks is way higher than the financial institutions. So having the two alternatives, they will probably choose the first one. And in Brazil, we have a particularity where the debentures, which is the local bond, can be both a bond or a loan. So we do a lot of what we call hybrid transactions, where we hold a piece on the loan side with banks, and a piece goes to the institutional clients. And it works perfectly because the same instrument, without any adjustment, can attend both demands. But I don't think the rest of the countries have that flexibility in terms of instruments. And when you go to the international market, and Sam can comment that, it's probably harder for institutional investors to buy a straightaway loan. They have to make a conversion into a note, and that requires an additional instruction. So it's always a secondary solution, and it doesn't happen on the primary round.
Any other questions? Are you, wait, is it a question or are you heckling?
Oh, yeah.
You have Ernesto behind you.
Just before you, Gonzalo. Yeah, no, just to compare the bond price curve and the loan price curve, bonds longer and cheaper, loans shorter and more expensive. Do you see how these curves behaved in the last 2 years, and how do you see them now? Is there shifting the curve, or what's the pattern that you see?
Neil,
Thanks.
I don't have a crystal ball.
Yeah, nor do I, but I'll speak confidently about what I think is going to happen. So I think that interest rates at the long end of the curve, I suspect, are going up, and in both local currency terms and in particularly in foreign currency terms. And I think there's a couple of reasons for that. In foreign currency terms, it's because the Fed's tightening, and I think the US markets are behind the curve on the extent to which US rates are going to go up. I think this tightening cycle is going to be a bit unique insofar as rates aren't going to go anywhere near as high as they have in previous cycles, but we could get the Fed funds up to kind of 2.5 to 2.75, even 3%, which is way below by 2019, and that's way below what the markets are pricing in. So I think interest rates in US dollar terms, particularly at the long end, go up. In local currency terms, I think risk premium has been compressed, and I think that's going to probably start to pick up too. So I would suspect that you see yields at the long end of the curve, both local currency and foreign currency, go up. At the short end, I think there's a couple of things that are going to keep them reasonably well anchored, actually, for the time being. One is inflation is going to remain relatively low across the region. And interest rates, the policy rates have probably got a bit further to be cut, and then most of that's probably priced into the market, but I think it keeps the short end of the curve down. That's the bond curve. I've got no real sense of how that interplays with the loan curve, but you guys might. I imagine one's just priced off the other.
Gonzalo?
No, my question is for Isabella. If you look at the last few years, before the financial crisis in 2008, if you added the volume of loans and bonds, corporate bonds, the mix was about 70% loans, 30% bonds. After that, of course, volume went down significantly and then recovered, and we are about the same levels than prior to the crisis, but the mix is now the opposite. Is this, in your view, the result of what happens in the US, where the capital markets have disintermediated the banks, and the banks are just providing revolving credit facilities and basically committed liquidity that the bond market cannot provide, of course, unfunded liquidity? Or do you think that there's other reason? Is that something you're doing yourself, meaning moving on to the capital markets with permanent financing, or is there another reason for that in the region, in your view?
Yeah, I think for a company like Fibria, you have access to both. You can go to bank loans or you can go to the debt capital markets. And as I said before, the debt capital market is much more volatile. So if you need the funding, and immediately, if you are in a hurry to get the funding, you will always rely on banks. And in Brazil, for example, to fund a project, banks are having a very leading role, as for example BNDES, the Brazilian Development Bank, is starting to slow down funding, so companies will start shifting for bank loans, either local or foreign banks. So I think it is this, and many companies don't even have access to the debt capital market, so the bank loans is mainly their only choice.
But I think also, could you be in a situation where all your debt would be in the debt capital market, I mean with long-term or bonds, and then just having liquidity lines with banks? I think that's what
Revolving,
the question.
I don't think so. I think we also prefer to have, as I said, the covenants package is much easier to negotiate if you need a waiver or something with banks. So if I have all my debt in the debt capital markets and something changes to the market and to the company, how would I negotiate to all of that investors? So it's good to have a very good pool of banks. Actually, it's good to diversify your debt, to have banks, development banks, and debt capital market lines, local lines. It's good to diversify.
We love your answer, of course.
But I think, with just one final comment from my side, I think that this intermediation that Gonzalo was mentioning is not really happening in a fast way in LatAm. I think what explains the figures on the DCM size is the concentration on sovereign and quasi-sovereigns. So when you look at the republics and the Petrobras, YPF, Ecopetrol, issuing billion-dollar transactions, of course, it's pushing the statistics up for that market, compared to the loan, which is a classic, large corporate business with some middle market names eventually accessing the market. So that's really explaining the contrast between the two markets. But I don't really see a lot of this intermediation because I don't see the DCM market going down on high yield intensively yet. They're still working on a few well-known names.
Yeah, and again, there's no institutional market, like as you can see in the US for non-investment market companies. I mean, single B issuers have no other option in LatAm than go to banks.
Exactly.
Unlike the US market.
Thank you, everybody, for joining us for the panel and for the panelists for participating. Thanks.
Thank you.
Thank you.